Why are private investments inherently less liquid? Imagine trying to sell a house versus selling a stock on the stock exchange. One can be sold quickly, the other might take months. That's the core reason private investments are less liquid. Unlike stocks or bonds traded daily on public exchanges, private investments are not bought or sold through a quick marketplace. They are usually part of private equity, venture capital, or private real estate funds. These funds are structured as pooled investments with specific rules about when and how investors can cash out. Most private funds have fixed terms that last several years, sometimes even a decade. During this time, investors cannot withdraw their money, which is called a lockup period. This lockup helps the fund managers focus on growing the assets without worrying about sudden withdrawals. Another reason private investments are less liquid is that their assets are often unique or complex. For example, owning a stake in a private company or a piece of private real estate involves assets that don't have a ready market. Selling these assets requires time, negotiation, and sometimes regulatory approval. Unlike stocks that can be sold instantly at a known price, private assets may take months or years to find a buyer and complete the sale. The final sale price can also be uncertain because there is no daily market valuation. From a financial planning point of view, this lack of liquidity means investors need to plan carefully. If you might need cash for emergencies or big purchases, putting too much into private investments can cause problems. Because these investments tie up your capital for long periods, investors often expect higher returns to compensate for the limited access. This extra return is called a liquidity premium. Financial advisors often suggest balancing private investments with more liquid assets like stocks, bonds, and cash. This mix keeps your portfolio flexible and ready for unexpected needs. Some newer investment funds try to offer more flexibility by allowing periodic redemptions or combining liquid and illiquid assets. Still, even these options tend to be less liquid than traditional public investments. In summary, private investments are less liquid because they are not traded on public markets. Their assets are often unique or complex, and they have restrictions on when you can access your money. If you are aiming for long-term growth and are comfortable with limited access to your capital, private investments can be a good addition. But it's important to plan ahead and understand the trade-offs between potential returns and the ability to access your money when needed.